Hello, here is number number five of the hotel model. What a bad start. I pressed right now. Oh no! I pressed F12, and this time we're going to do hotel financing. And I hope we're just about finished here. Okay. Once we have the project cash flow, let's begin with the financing. Now, if you remember, we put you don't remember, you might have just opened this one here. We have a loan. We have a loan to value land cost. So we're going to loan 80% of the land, pay it back after the project starts in 10 years. We're going to pay a credit spread on this. We're going to have, for a construction loan, 65% of the land cost, and we'll have a cash sweep percentage of 70%. And here's what we're going to do at first. When we structure these loans, this loan to value will not include any interest during the construction period. Okay, and I think we had some assumptions somewhere up here. I think I just skipped over them. We had the interest rate. Okay, why in the heck? Okay, okay, so, and I don't think we need any of this stuff. We can press shift alternate right arrow, and then I thought we pressed number 1. Okay, so now we can kind of see what we're doing. And for the financing schedule, let's start with the 2 debt issues. Land loan, and then start with an opening balance. We better add the draw, which is going to be at the time we spent money on the loan, and then less the repayment scheduled. Now this is, and that's, why don't we, I can't remember, we put it here. So this scheduled repayment is over 10 years, but we have 4 quarters per year, so we do it over 40 periods. Okay, and then we'll put a closing balance. Now let's put an interest, let's put the LIBOR rate in here. And that's, let's put a periodic. Remember, here's what I should have done. We need this periods per year, so here's what we can do with this one. Select this, shift alternate left arrow takes it away, shift alternate right arrow, and then we can see the periods per year, because we're going to have to divide the LIBOR rate by this number depending on what quarter we're in. Okay, and then we'll put the credit spread and get a total interest. Now this credit spread, if you got really kind of, it's not so fancy actually. You could put a different credit spread for a different time period. Okay, and whoops, that was the construction loan. Okay, I don't know how to protect against errors like that. Perhaps make a IRR on the loan, and it better be somehow we better see it then, and then we can get the interest rate, interest expense. Now, and we can also get interest capitalized. Okay, so because we might have interest that's during the construction period that's not, you know, okay. And I suppose, did we put any fees on this one? For some reason, I didn't bother to put any fees on this one, but I put, I'll put the upfront fees and the commitment fees on both of these. Okay. You know, I don't want to, I'm going to have a circular reference with these on the construction loan with commitment fees. So here's what I'm going to do. I want to keep this model relatively simple. There are so many different videos on fees. If you want to watch one of those, watch one, please. And maybe I'll make one of this later, but not right now. So now let's do the same thing for the construction loan. Now, on the construction loan, let's first put the loan size. And what we have is two things. We have the cost of the facility, and then we then we have the loan to value. Okay, and we put that assumption in. Okay, now once we have these two, we can multiply that and get the loan size, and then we put the what we're going to do is see how much equity commitment has to go in, and subtract the debt commitment. Okay, so I'm going to make this pari passu, a Latin word, not a French word. Let's put opening balance, and then we'll add the construction, the draws, which will be the 65% of the total, and then we can put less the repayment from the cash sweep, because that's what we put. Now this is, we should also here, I missed one, I put less repayment of balance at exit. Now this is what I want to show you. This one is going to come from downstairs. This one is going to come from downstairs. We don't know how much we have to pay, and then closing balance, we can then, I think I'm inserting one, shift space bar, shift control plus, and we put interest, periodic LIBOR rate, and then credit spread, and finally the total interest rate, and interest expense, and interest Okay, that's what we need to do now. So put all of these now. What I did is something extremely simple. We to get the amount of the draws, we actually need a. We can call this almost a sources and uses, which is like a financing during construction. Now, what we start is with the asset side, so uses. Just like if it was a balance sheet, that would be the assets. And we can put development cost, and then we can put land cost, and we can put construction cost, and then we put total. That's pretty simple. Okay, it's very simple because we've already done it all that we did up here. Remember, here's the development cost, the land cost, and the construction expenditures. We did the hard part on that one already. And then we put the sources of funds, and let's put, when we go to the sources of funds, let's put first the just got to sit up here. Let's put the land loan, and that's going to be 70, whatever, the 80% of our land cost. And then we can put below the land cost, let's put the construction loan. Okay. And we said, well, that's going to be 65% of our construction. So what we do here is just multiply this by the land cost, multiply this one by the construction cost, and we'll have total sources. Now, here's the real problem. Under this, one of the other uses of will be the interest during construction. Now, what that will mean, I'll just tell you right now, this 80% is 80% only of these numbers. We have to finance the interest during construction by equity, essentially. So it's a little bit, I don't know if you want to call it simplistic or distorted, but let's just get these in. Okay, so we have sources of funds, uses of funds, we put the construction loan in and all of that. Okay. Once we have all of these things built, the next thing we can do is finally, now the biggest mistake here would be to put this too early, profit and loss. We almost don't need this. The only thing we need to do is put a tax rate in here, which we have up here somewhere. Well, I'm just gonna, it's theoretically, of course, possible to make the tax rate change over time. Sometimes some projects, I think, in Singapore, for example, there's kind of a 5-year, some kind of rule that you if you sell it before 5 years, you're trading, you're speculating, and you get a lower capital gains tax if you sell it after 5 years. I think 0, perhaps. So where we put general economic assumptions, and then we put the financing and the tax rate. So we'll put that in, and then we'll put the revenues less the operating cost, and then we can put cash income. How's that? And then we can put less the depreciation, and we can call that EBIT, and then we can put less the interest on the land loan, less interest on the not the land loan, the construction loan. And then after we do that, we'll put EBT, and then we can put less taxes, and we could put earnings. E. See the E's? This could be called EBITDA. That's what I would do. Earnings. Okay, not very complicated. Only calculation in this whole thing is simply the taxes. Okay, and finally then we can put cash flow. Notice what I'm doing is I'm putting the cash flow in here before we make any calculations. And we can start with the EBITDA. This cash flow I'm going to just make over the operating period, less taxes. How about we'll add exit proceeds, and then we'll put operating cash flow. Now then we can put less interest on the land loan, less interest on the construction loan. Now it could be that the land loan is senior to the construction loan, and then you would have to make a subtotal potentially, and we can put cash. Oops, why did that happen? Cash flow after interest. And then why don't we put less scheduled repayment on land loan. Remember, that's from above. And we can make a cash flow after land loan repayment. Now, it's possible that we have to then repayment of land loan balance at exit. Now then we can put cash flow after land loan repayment. Okay, repayment at exit, and then we can put less repayment of construction loan. Now, how did I make the repayment? We said that is going to be we said, well, we'll just sweep 70%. Now, it's totally possible, I suppose, that we still have some loan left over, and so let's put cash flow after repayment, and we better less repayment of construction loan at exit, and then we can finally put dividends. Now this sounds like it's going to be really hard, but it's really not. So this repayment of construction loan is going to be driven by the 70%. And I think we really have everything done. And finally, we can have net cash flows. And we can have equity cash flow, and then equity IRR. And I'm going to stop here. We could put debt IRRs too and all of that, but I think that's just about enough. Okay? And it sounds like, oh no, this is going to be so hard, but it's not. So let's start just by linking. A lot of this is just going to be a simple link of various things. So we put the construction cost, then we put the land loan cost, the land expenditures rather, then we put the construction expenditures. Okay, you know, I'm going to multiply this by 1 too. And then the interest during construction, that's a little bit tricky. It could even lead to a circular reference, but let's take these two and then get our interest capitalized down here. Okay, Shift Control 1, and then alternate equal to sum these. Okay, and then we can take our land loan, which is at F4 because it's over here, multiplied by simply the land cost. That's not so hard, is it? As long as I get it in the right place. And then we take the construction loan and we multiply that by the construction cost. Shift Control 1, and then we can press Alt equal again. Okay, opening balance, only one thing to remember. It always equals the prior year closing balance. Never do this, you'll get a circular reference. Always go to the prior year, okay? Alright, that's the lesson number 1 in financial modeling. Then we can put our land loan draws. Now, this scheduled repayment at exit comes from down here in the cash flow statement. This to me looks like 206. That's the key. Somewhere in these schedules there'll be some kind of plus the draws minus the, oops. What did I just do? This is at exit, excuse me. Now this total land loan, I suppose we can do something I'll do it like this. If we sum up all of the draws, we can get how much we're going to have to repay, and then we better take this total amount divided by this amount and multiply it by the, we don't start repaying until we have the operating section, so we needed that again. Now the LIBOR, if you remember, okay, first we're going to have to open our little thing. I guess it took us to the wrong place. That's too bad. I didn't kind of realize it would do that. If we type lookup, okay, and put I still remember this nice young man had told me to use lookup, and of course I did it wrong. You just look up one value, and then we find our interest cost, and we click on the year, and then we click on the entire column. Okay? If you're watching this, it must be incredibly boring. Now, I press Shift Control P, and we'll divide that by how many periods per year we have. Okay? And our credit spread is just flat. And then we can press alternate equal. Okay? I was going to try to say something a little more profound. On this one, multiply it by the opening balance, not the closing balance. And then if it's capitalized, we take our total interest and we multiply that by the construction period. That's when we capitalize the interest. Now the interest expense, this should be interest cost. So this should be this minus the capitalized interest, I suppose. Oh, we can't do that. Let's just multiply that by the operating periods then. I'm not going to let it get to me. Is this the up? Oops. Okay, I did it. Let's close this so we can see what's going on. Now the loan size here is a little bit more complicated. It's not really, actually. The way I'm doing this, we're making it relatively simple. We can get this a lot more complex, unfortunately. Shift Control O. We can put the opening balance equals the closing balance. 174 it looks like. Now the debt draws. Whoops. The debt draws. The opening balance equals the closing balance. Okay. Debt draws. We could put that here, but this is 75% of the construction loan. Not the construction loan, the I'm sorry, we already did this. We already have the construction loan. Excuse me for that. And then the repayment from the cash sweep, that again, that's the key here. That repayment from the cash flow sweep comes from down here. Now we need to add one more line down here. Less repayment at exit. Okay, now the reason we're getting that from downstairs, it is totally possible that you have no. It is slightly possible, how about that? That, and always take it from the same column, always, always, always. It is possible that the cap rate and everything's so bad when you exit, you have no cash flow. So we take the opening balance plus the debt draws minus these minus this. I can't remember doing this up here. We must have done that. I was right. I'm not going quite. I thought I was going senile, but I probably am. But I remember I didn't do that one. Oh, that's amazing. Okay, and then we can get the LIBOR rate, which was kind of a pain to get, remember. And then we can get the credit spread, which, of course, I did incorrectly because we should have divided that by 4 and put it in periodic periods. And the credit spread for our construction loan is presumably a tiny little bit more risky, so we take this one. I didn't have to do that, but so let's take this one, F4. I hope I pressed F4. I did do that. And then we press alternate equal, and we can get the interest expense, which is the total rate multiplied by the opening balance multiplied by the operating periods here. That's, and then we can do the same thing and multiply it by the construction period. Okay, and we have that finished. Tax rate, we'll just press F4. Okay, revenues, now go up and get the revenues. And we get them from him. Okay, and then we can get the operating cost from here. And we get the EBITDA as the difference. Okay, and the depreciation now, this is a big issue. We have, I'm going to call this the base depreciation, and we also put less the depreciation on the capitalized interest. Now, okay, and I think we need another little section here. This is always kind of a little problem. We put depreciation on IDC, or capitalized interest. Now this is just like we had before. We put an opening balance interest, and then we can put opening balance. Let's add the interest. Oh, come on. Capitalized on the land loan. Add the interest capitalized on the construction loan. And put a closing balance. Now, then we can put our depreciation rate. Right, and finally, let's put the depreciation expense. No, let's just put the depreciation expense. And let's put accumulated and then finally underneath the accumulated depreciation, the net plant balance. Okay, so we need this one, and let's just take this depreciation from here. Is that 189 now? I think I might as well do this. Opening balance equals the closing balance. The depreciation on the land loan, depreciation, the interest on capitalized on the land loan is here. Interest capitalized on the other loan is here. Alternate equal to add them up. Shift control down. Shift control 1. Depreciation rate. Hopefully we can just get from the depreciation rate we did here. Here, remember, we take the we can take the opening balance, multiply it by this, and we don't begin it until we have the operating switch. And so our accumulated depreciation is last year plus this year. Net plant balance is the closing balance minus the accumulated depreciation, and we have to adjust this one and put minimum of this number or the opening, the plant balance from the prior year. That I did a little bit quickly maybe, but there we go. And then the depreciation on the capitalized interest, did I just get that? I didn't get this yet. 189. This depreciation is from up here. So we have the two parts of the depreciation, which means our EBT is this one. Now, again, I told you that when I was an accountant in 1982, I had this accounting boss who told me the rule of lines and got really mad if I didn't use the correct lines and subtotals. I have no idea if I'm doing it correctly now, but I like to show the subtotals because that's the only real calculation you have to make, and then we can get the interest expense from the land loan. Okay, there, and then we can get the interest expense from the construction loan. Okay, and then we can make another subtotal, this one minus this one minus this one. Okay. Oh, I think I could have just done that. Oops. And put another subtotal. And then we can, the reason I put the tax rate up here is that's the only calculation. Now we could have net operating losses and get complex with the tax calculation. There are all sorts of really interesting issues with the tax calculation. And we can do this, okay? And now we get the EBITDA from our line above. We get the taxes just from here, and the exit proceeds. I don't know if you remember that, but we had to make that calculation up here with the, I forgot how we did, oh, the cap rate, I think. And then we have a subtotal, which is this minus this plus this, okay? And we click on this, but this time, again, it's not quite a final total. And then we can already take the interest we computed on the loans. Okay, and finally we can get the cash flow after the interest. Whoops. Okay, which is this one minus this one minus this one. Okay, and we put this in here, and then oh my. Okay, and then we can now go back up and get our scheduled debt repayment from the land loan. Okay, that doesn't begin till afterwards. And then we can get our cash flow after this, which will be another subtotal. Oh, I didn't realize I could do that. And then we can get the cash flow at exit, which is either this cash flow. We never want to, let's start the easy part. We never want to pay more than the opening balance. But if we don't have any cash flow, that's too bad for those poor bankers. So we take the minimum of this or this. I suppose it's theoretically, if this was negative, we could also cap it at 0, which means we should put a maximum and a minimum, okay? That's kind of the maximum and minimum rule. And then we take another one and press, and we have another subtotal. Did I press that? And then the repayment of the construction loan, okay, is this cash flow sweep, which means we take the minimum of how much cash we have, but we multiply that one by 70%, but we never pay off more than the balance of the loan, and you always use the opening balance. So that's the only real trick. And then you have another subtotal. Well, I guess the other trick is a subtotal. And then we can take the construction loan at exit. We'll, again, see if we need it. So we see how much this, now, I made a mistake here. This is the minimum of the opening balance minus the amount we've already taken in the cash flow sweep, or this, and we need to do the same thing for the last one. So this, let's put this as a double underline, okay? And so we kind of have everything. There's one thing. Where's the land loan at exit? This one. This, no, this one. So this is the minimum of this one. We should take out how much we've already paid from the minimum. Oops. Did I do that right? Okay, I hope I did that. Okay, and then we can get our equity cash flows, which is the positive cash flow, but we should subtract this key thing up here, which is how much we've put into the company. And that we need to do. Oh, how could I have done that? Okay, it's good. I kind of left that out. Maybe I'm pretending that I wanted to. Okay, and then we put equity funding. This is how much we take the total amount we have minus the amount we've put into the project, and this better be an alternate equal. Okay, and we can put the total fundings. Oops. And then we put this one here, okay? And I don't believe so. So our total equity cash flow is the dividends we get minus the amount we put into the project, which is the equity funding here. That's the amount you take out of your project, and then we'll compute the IRR over here, and then we'll be finished. And the only thing we have left to do really now is to go up here, shift down, okay, now, and we press shift control R, and look at this. Oh, it did work. Phew. Okay, so now we can, let's just kind of look at our cash flow statement a bit. This, so far we have nothing, we're just taking out, and then as soon as we begin the project, here's how much we have, and oh no, we had a negative tax. Okay, so what for now? And then here's our interest and our repayment, and now I made a mistake because we have less repayment, cash flow after the repayment, and this should have been the minimum of, oh, I didn't multiply this. Did I really not do that? Okay, I didn't. I can pretend that I didn't do that. But this, of course, would have to be multiplied by the exit period, and this would have to be multiplied by the exit period. Okay, and shift control R. Okay, so now we have some positive cash flow. Cash flow, yes, now we don't have any money coming out of the land loan until the exit, and it looks like scheduled repayment on the land loan I did wrong because we have some interest on the land loan, which is totally fine because I made another mistake because I didn't use the minimum function, but we're kind of getting there. And then so on both of these, not on this, but on this land loan, when we have a scheduled repayment, we would never ever pay off more than the amount we have at the beginning, which is here. Shift control R. So what we should really do is check. This is our loan is going down, and it better never get negative. This construction loan is going down, and it gets fully paid off. And the rest is the equity cash flow. And where did I put the I put it right in the beginning, and if you remember, what we used is XIRR, and we clicked, I suppose, this line first, and then we after we clicked that line, I lost the thing, so just a minute, we have to put our opening and beginning and ending period. Oh, come on. Come on! Let's XIRR, and let's try this one, and then put the these on. Okay, so that then we get Shift Control P, and there's our hotel financing. And you know, here's what I'm going to do. I'm going to save it, not as hotel financing, hotel summary, which is our next sheet. So if you want to work on this, you have to go out and do it yourself. Now, I might leave the titles in here for you and make a nice little exercise that you could attempt to follow. But I think that's enough. That's enough for this one. So this is exercise number 5. That took 45 minutes. Oh my gosh.